everyone's joining quite promptly. It's quite nice to see.
Good.
Well, welcome everyone. Give it a minute for everyone just to log in, but yeah, I need to also close my door.
I've got an open door policy.
Well, I actually also have an open door, but with the background you can't really see it. But
looks like you're sitting on the beach. Actually, never mind open door. Looks like you're on the beach.
Yeah, we are. You're going to be doing all the work after all.
Just don't fall asleep. That's all.
No, I switched my camera off. You're not going to see that. But anyway, you keep it most interesting. I can't fall asleep.
that second answer was the correct one. Yeah.
Like I say, flattery will get you everywhere. So just give it another minute and we'll be starting. Welcome everybody at this point. Also, a big apology for the mix-up in the times. I'll be a bit more careful next time. Sometimes more haste, less speed.
Yeah, I think we're about halfway in. Half the attendees are in so far. But I think, Stan, do you want to start your introduction? And hopefully by the start they join. Or Jackie, do you want to just check your screen? You're on the right presentation side because you got the.
Oh, is it? Oh, I see what's happening here. Let me just swap the displays. Does that look better?
Perfect. Yeah, that's
okay.
Okay, so welcome everybody. Welcome to another taxing afternoon with Jackie Arendse. And looks like an exciting discussion about VAT and provisional tax, everybody's nightmare. And thank you for joining us. Again, apologies for the mix-up on the times. As I said, I'll be a little bit more careful next time and not just jump in and copy and paste. So we're going to have a break at about halfway through. It's about 3:10 or 3:15. For a few minutes, and then we should finish just before 5. Unless there are questions that Jackie needs to answer. So without further ado, Professor Jackie, the floor is yours.
Great, thanks very much, and good afternoon, everybody. Well done for logging in so quickly. It's lovely to have you all on board and ready to go. And I hope it's going to be an interesting conversation this afternoon. So as always, if you have any questions, please feel free to pop them into the chat box or the Q&A. I don't mind which one. I might pick up some questions as I go along, but otherwise I'll pick up questions when we have a tea break, and we'll have a tea break sort of 10 past, 3, somewhere around there. We'll stop for 10 minutes and then we'll carry on, and then we should be done between 4:30, 5. All right, so if you have any questions, hopefully on the topic at hand, but pop them into the chat box and then we'll pick them up. So it's kind of broken down into 2 parts, although before the tea break, we'll probably start on the second part, because the second part I've added a little bit of an extra bit in for you. But essentially, we were due to talk about VAT and provisional tax. And so I'll talk about VAT first, current developments in VAT. So there's one recent case law judgment that's worth discussing, and then drawing on from a previous judgment, but something that was highlighted in the recent SARS VAT Connect that was published in June, is on this question of imported services. So I'll just talk a little bit about that, and then we'll go on and talk about Section 72 and the VAT rulings. And my iPad's doing strange things to me here, so let me just switch it off. And then we'll talk about the draft amendment bill, which has a proposed amendment relating to VAT in it. Okay, so let's start off talking about this latest judgment. And this was the Turves judgment that was handed down a couple of months ago, in fact, I should say a few months ago, this year's going by so quickly, it was handed down in May. And Turvest, they run the American Express outlets in South Africa. So this deals with current exchange of currency. Now, as soon as I say exchange of currency, then you'll probably, hopefully, your immediate response is, well, that sounds like a financial service, and a financial service is an exempt supply, right? The supply of an financial service is an exempt supply, and therefore would not carry VAT. Now, the issue with Turvest is that they had these various branches around the country where they were exchanging currency. But of course, the exchange of currency itself is a financial service, but they then charge commission for that service, just like with a bank. The bank charges bank charges, right? And they would levy VAT on their bank charges, although they wouldn't levy VAT on interest or exchange of currency or anything like that, because those are financial services. So financial services is an exempt, the supply of financial services is an exempt supply, except that there's a proviso, we'll come to this just now, that refers to commission or a fee charged for the provision of the services. Now, so the issue with Turvest was that they ran these branches and they were exchanging currency at the branches. And the question was, how much input tax could they claim? That was the bottom line of this. Because if you think about it, you can only claim input tax on goods or services that are required for the purposes of making taxable supplies, right? And so if you have a company that is making mixed supplies, both taxable and exempt supplies, then your input tax is apportioned between those taxable and exempt supplies on the basis of sales. How much of your sales is made up of taxable supplies? How much is made up of exempt supplies? And if it's, let's say, a 60-40 split, then you would split your input tax 60-40. But that's actually input tax that can't be directly attributed, because just with any good costing exercise, if you can attribute specific expenses to those specific areas, similarly, you would attribute input tax to a specific area. So expenses related to the provision of exempt supplies, box A. And so any related input tax would go into box A, and then you wouldn't be able to claim any of that input tax. Input tax that relates to the making of taxable supplies, that box B, if you like, and then you can claim all of that input tax because those are expenses that are 100% incurred in making taxable supplies. So you would do the attribution where possible, that then when you can't specifically attribute, when you've got overheads, for example, that relate to the business as a whole, then you would do the apportionment, and the generally accepted basis of apportionment is on the basis of sales, as I say. What percentage of sales makes up exempt supplies? What percentage makes up taxable supplies? Now, Turvest for many years had gone about this process of basically allocating their input tax and actually using an apportionment method, allocating input tax between taxable and exempt supplies and claiming accordingly. And then they got, obviously, some people to come in and do a VAT review for them, and they were given advice that actually they could do a direct attribution. They could actually look at their branches and they could say the branches actually themselves are not making exempt supplies. The exempt supplies are coming from the Treasury division at head office, let's call it that. The branches themselves, all they're doing is that they are basically exchanging currency at the rate that is determined by the Treasury function at head office, and the branches are charging commission on that. And so on that basis, they were arguing that the branches themselves were basically providing taxable supplies, and it was this Treasury function of head office that was providing the exempt supply, if you like. And so on that direct attribution basis, they were saying all of the expenses of the branches, particularly, they would claim all of those input taxes as being on the basis of making taxable supplies. Now, this went through the tax court, and the taxpayer was actually successful at the tax court. And you can see here that it was SARS who took the matter on appeal. You see it's SARS versus Turvest, right? So SARS took the matter on appeal to the Supreme, directly from the tax court to the Supreme Court of Appeal. And basically SARS was arguing that this direct attribution that the taxpayer was doing was not appropriate, that they should be doing an apportionment between taxable and exempt suppliers. So you can see the facts as I've explained them here. The dealer in foreign exchange, 52 branches countrywide. There is a margin when they exchange foreign currency, and that rate is set by their treasury function. Then the branches buy or sell between them and the customer, and they would obviously charge commission. Now, we accept that the commission is a taxable supply, but the actual exchange of currency and that margin, the profit margin on the exchange of currency apart from the commission, that would be an exempt supply. So the question before the court was whether the respondent, the taxpayer, in conducting its enterprise of the exchange of currency through the branch network, was it making both taxable and exempt supplies, as SARS contended, or was it at the branches only making taxable supplies? So the issue was, it relates to the input tax on the expenses incurred at the branches. And it's quite interesting that based on the advice that the taxpayer had taken, they had gone back and they had redone the last 5 years of their VAT returns, basically now claiming all the input tax relating to the branches. Previously, they had just done a straight apportionment, of course, and by claiming this on the direct attribution method, they were claiming an additional input tax of some 24 million rand. And that they claimed in September 2013. So the facts do go back quite some time. As we know, it always takes quite a long time for these matters to go through the whole process and end up in the court. Anyway, it was after the SARS audit that was done 3 years later in 2016 that SARS then reversed all of that input tax of 24 million rand on the basis that I've just explained. So if we look at the VAT Act and the provisions, so input tax, that's driven through section 16.3 of the VAT Act. And if we read that together with the actual definition of input tax, which sits in section 1, that tells us that we can deduct input tax where the goods and services are acquired wholly or partly for the purpose of consumption, use, or supply in the course of making supplies. But if they are so used partly for such purpose, then to the extent that they are used for taxable supplies. And that's the issue, to the extent used. So as I said earlier, if your turnover indicates that you've got 60% taxable supplies, 40% exempt supplies, you look at all the expenditure related to producing that turnover, then you would be able to claim 60% of the input tax, because that's to the extent to which those goods and services are used for making taxable supplies. Of course, this reference to section 17 has specific prohibitions where you simply cannot claim input tax, and that's on things like entertainment, motor cars, and your sports clubs and so on. Those subscriptions. You can claim professional subscriptions, but not subscriptions to sporting and social clubs. Okay, so that's the general rule with claiming the input tax. And when we look at taxable versus exempt supplies obviously are set out in section 12, and section 12A talks about the supply of a financial service, and financial service is then defined in section 2. And if we look at section 2.1a, it says the activity of the exchange of currency is a financial service. So just to clarify, and I think we all know that the exchange of currency is a financial service, but this is where it comes from. But then, although we have defined financial service in section 2, there's a proviso to section 2.1, which excludes from financial services the activity of the exchange of currency to the extent that the consideration payable is any fee or commission. So as I say, similar to with a bank where they have bank charges, the bank charges are levied. That's a fee that's charged to the bank for providing those services. That's a taxable supply. But the actual raising of credit or advancing of credit, charging interest and all those sorts of things would be an exempt supply. Now, it's quite interesting, if we look at the history of this, when the VAT Act was first introduced back in 1991, and this is a point that's given to us in the judgment, they make the point that initially the VAT Act included as exempt supplies all financial services. So the legislative policy was basically to exclude financial services from the VAT net. And they said that that was because of perceived difficulties in establishing the value added by financial services on a transaction by transaction basis. So they said the exchange of currency was from the outset, from the time the VAT Act was introduced, it was an exempt financial services and didn't attract VAT, not even commission attracted VAT. That was also part. So financial services in their totality were originally treated as exempt supplies. But then the Tax Commission had a look at the VAT system, and following the report of the Tax Commission in 1995, so remember VAT was introduced in 91, then the Tax Commission gave this report in 95, and they recommended that fee-based financial services should become subject to VAT. And so in 1996, the VAT Act was then amended to incorporate this proviso that I've just referred to, that says basically, the financial services are exempt supplies, but to the extent that you've got a commission or fee that is charged, then that commission or fee is not an exempt supply, it's a taxable supply. And so in the judgment, the point is made that if we look at the way that the VAT Act is structured, and we look at this concept of exempt supplies and how financial services fits into that, they made this point: if no fee or commission were charged by the vendor or the respondent as consideration for the supply, the whole activity would have been exempt and no input tax would be able to be deducted. If you think about that, I mean, their business was exchange of currency. And so if you didn't have this carve out of commission, then the whole business would be involved in making exempt supplies, and then you'd get no input tax whatsoever. But the proviso then states that the activity of the exchange of currency is deemed not to be a financial service to the extent to which you are charging fee or commission. So it's a carve out that exists there. And the effect of that carve out is limited to ensuring, in keeping with the intention as expressed in that 1995 Tax Commission VAT subcommittee report, of bringing financial services into the VAT net, that any commission or fee charged in respect to the activity of the exchange of currency will attract VAT. And to achieve this, it's necessary to carve out the activity from the definition of financial services. And so what the judgment concluded was that you can't say that if you look at the branch itself, the branch is only making taxable supplies, when the very nature of the vendor is that they are doing currency exchange, they're exchanging currency. And so the nature of the vendor is that it would normally give rise to exempt supplies, except for the carve out of the commission. And so it's only the carve out of the commission that then creates this mixed supply. And then based on that, the vendor has a mixed supply, and therefore there's both taxable and exempt supplies. And that means that you have to apportion the input tax, and only the part attributable to the taxable supply may then be deducted. So the respondent's attempt to claim the entire VAT charge was totally rejected by the Supreme Court of Appeal. And so unfortunately that 24 million rand that they claimed as an input tax credit, and then SARS reversed that. Well, it held that the SCA held that SARS was correct in that treatment. And in the result, they upheld SARS appeal, and they also confirmed the finding of the cost order around from the tax court. So the issue here was that the taxpayer, the vendor, had to apportion the input tax. They couldn't go on the basis of saying all of the activities at branch level were taxable supplies. So they had to apportion across the board, and they were not able to claim that 24 million rand in input tax, bearing in mind that was 5 years worth of input tax. Okay, so I guess an interesting aspect there, if we think about what are the takeaways from this particular case, obviously not everybody is in the financial services industry. And many of you are probably not involved in the financial services industry. But I think what is really important here is this aspect of, first of all, what is input tax? When can input tax be deducted? And if you have a business that has mixed supplies, then make sure that you are doing the apportionment correctly. Yes, you can do attribution of costs if you can. And in fact, SARS specifically confirms this in their VAT guide, is that they talk about attributing costs. That's the first port of call. If you can attribute costs to specific activities, then you would do that. But then any costs that are incurred generally across the board for the whole business, you would apportion the input tax on those costs on the basis of your sales, unless you've got a specific ruling from SARS to use a different basis of apportionment. But otherwise, the default position is on the basis of sales from year to year. You'd look at what percentage of sales comprises taxable supplies versus exempt supplies. Okay, and I think just another point, I was chatting to Stan before the webinar started, and we were just talking about VAT and claiming of VAT and so on. Remember that also, before you can claim VAT as an input tax credit, you have to ensure that you have a valid tax invoice on hand. And in some cases, you also need additional documentation. For example, if you've got imported goods, if you have secondhand goods on which you're claiming a notional input tax credit, there's additional documentation that you have to have on hand before you are eligible to claim the input tax credit. And I think the key thing there is to make sure that you have inbuilt controls in your accounting system to make sure that the VAT is never claimed as an input tax credit unless you're 100% sure that you are actually eligible for that input tax credit. I think it's a big area of VAT risk. And of course, if one does have an audit from SARS, as you can see with Tourvest here, SARS reversed input tax to the tune of 24 million rand. And then, of course, that is going to give rise to penalties and interest. And so it can become a very costly affair, never mind how time-consuming it might be when you have all these interrogations being done by SARS. So the key thing is to have controls in place. And I think, you know, one shouldn't have to mention this, but sometimes it's important to go back to the fundamentals and just mention the fundamentals again of having proper controls in place to ensure that you are not debiting your sort of VAT control account, as it were. You're not claiming the input tax credit unless you are specifically entitled to it. Okay, so yeah, just quite an interesting one on this case of Tourvest. Then turning a little bit away, although also to an extent, still staying within the VAT area, is an older case. We actually discussed this case in my May 21 mid-year tax update. It was actually a judgment, also came from the Supreme Court of Appeal in December 2020, and it dealt with Consul Glass. Now, Consul Glass also dealt with input tax to a certain extent. It dealt with two aspects. It dealt with input tax and it dealt with raising output tax on imported services. Now, Consul Glass is in the business of making glass bottles, right? I don't think there's anybody in South Africa who's not aware of what Consul Glass does. So they're in the business of making glass bottles. And if we talk about their taxable supplies are in the form of making glass bottles. So they had entered into a debt restructuring arrangement. They had originally raised several billion rands worth of funding on euro bonds, and that became expensive as the rand depreciated in value. So they then wanted to switch into local borrowings. In the course of doing that, they used the services of consultants, some of whom were local consultants who charged VAT, and others were foreign businesses who obviously didn't charge VAT because they were not registered vendors. They were operating outside of South Africa. So as far as Consul was concerned, they had claimed the input tax credit on the consulting fees that were charged by the local consultants. And SARS argued that they were not eligible to claim that input tax credit. And then on the other hand, as well, as far as the foreign consultants were concerned, SARS held that those were imported services. And so they said that Consul should have raised output tax on those imported services. And Consul had not raised that output tax for the same reason as they had claimed the input tax on the local consulting fees, is that they said that they were using those imported services for the purpose of making taxable supplies. Okay, then the question, of course, is, were they using these services for the purpose of making taxable supplies? SARS said that they were not. They said that actually restructuring of the debt, the original raising of the debt, and then the restructuring of the debt was not specifically to make glass bottles, if I can put it that way. As I said at the beginning, it wasn't specifically to make additional taxable supplies. It was actually to make the business more efficient and to cut the financing cost of the business. And they said that there was not a close enough link between the actual consulting fees and the making of taxable supplies. Certainly, they said that Consul Glass had not discharged the onus upon it to prove that there was a close enough link. And so on that basis, they said that the consulting fees were not incurred in making taxable supplies. That meant that there was no deduction of input tax on the local consulting fees, and you would have to raise output tax on the imported services, on the foreign consulting services, because that fell within the definition of imported services. And this is what I want to pick up on and discuss today, is this concept of imported services. This is something that was highlighted in the SARS VAT Connect that was published in June. And if we look at imported services, so first of all, if we look at the charging provision in the VAT Act, Section 7.1c, just to break this down, Section 7.1a is the general charging provision that says that VAT must be levied on any supplier by a vendor of goods and services in the course of carrying on an enterprise. Okay, that's kind of the key VAT provision, is that Section 7.1a. Then Section 7.1b says that VAT must also be charged on imported goods. And then Section 7.1c says that VAT must also be charged on any imported service. But then imported service is defined in Section 1, and it means a supply of services from a non-resident to a resident to the extent that the services are used other than for making taxable supplies. Now, that's why in the Consul Glass case, this became an issue, because when SARS was successful in arguing that these consulting fees, local and foreign, were used for the purpose of restructuring debt, and therefore their purpose was making the business costs more efficient, cutting down on the financing costs, they said that was not specifically for the purpose of making taxable supplies. So here we have consulting fees provided from a non-resident to a resident, and the services are used other than for making taxable supplies. So that falls into the definition of imported service, which then feeds into Section 7.1c, which says VAT should have been charged. Now, just as we see with Section 7.1b, this is not only vendors who have to pay output tax on these items. Section 7.1b and 7.1c, it applies to anybody. You know, I mean, if you go online and you order, like I did the other day, some clothing, which is a bit risky sometimes buying that online, but nonetheless, when you've got a wedding coming up, sometimes you do these crazy things. But if you'd go and order things online like that, you will get a notice to say you have to go and pay customs duty and VAT, all right, before you can claim those goods. And so even as a non-vendor, of course, you have to do that. And with imported services, similarly, it can be both vendors and non-vendors who have to pay VAT on an imported service. In fact, it might even apply more to non-vendors, because non-vendors, for sure, if they are using services of a non-resident, they will be using that for the purpose other than for making taxable supplies, because they're not making any taxable supplies. They are not a vendor. They can't be making taxable supplies. Okay, so this issue around imported services and paying VAT on these imported services becomes another area of risk, because you can't plead ignorance and say, well, I didn't know, therefore that's why I didn't pay the VAT. The law is there, and we are supposed to know when we have to pay VAT. So Section 14.1a says that where VAT is payable under this provision, then if you're a non-vendor, you pay the VAT through the mechanism of the VAT 215, and I'll go into this in more detail just now. If you're a vendor, then what you would do is you would declare that output tax in your VAT return, the VAT 201, for that particular tax period, right, in which the supply takes place. That's when the services are rendered. Okay, so that Section 14.1 tells you when and how you have to pay the VAT. The time of supply, we are told in Section 14.2, is when the supplier issues an invoice or any payment is made, whichever happens first. When they talk about invoice, obviously it's not a tax invoice. Invoice in that context is referring to an obligation. When there's an obligation to pay, there's a piece of paper that says you're going to have to pay this amount. So when either you have an obligation to pay or you actually make any payment, whichever happens first, that's the time of supply. And section 14.3 says the value of the supply. And remember, VAT is calculated on the value of the supply, which is either the consideration actually charged. And so your foreign consultant might charge you R1 million consulting fee. There's no VAT in that per se, but on that R1 million, you would need to pay VAT, output VAT. Okay, so the value of the supply is the consideration that is charged. So on that, you would pay 15%. Or the open market value. And open market value, by definition, includes VAT. So if you were working out your output tax based on open market value, you would multiply that by 15 over 115. So whichever is the greater. So it's interesting that the value of supply rule here is similar to the value of the supply rule you would normally see between connected persons, but this applies even when there's no connected persons. It has an inbuilt sort of transfer pricing mechanism, if you like, saying that it's the greater of actual consideration or open market value. All right, so whatever is the value of the supply at the time of supply, the person receiving that supply, who is a resident in South Africa, is the one. Notice here it says to a resident, okay? So it is the resident who has to raise the output tax. There are some exemptions to this, though, and that sits in section 14.5. So there's 5 specific exemptions. The one is where if the supply would have been exempt or zero rated if it was supplied in the Republic. So if we think about what supplies in the Republic are exempt or zero rated, we could think about things like financial services, we just spoke about earlier, things like educational services, zero-rated suppliers. We've got that whole list of zero-rated suppliers like raw foods and things like that. And then the alternative is if the supply of the service is subject to VAT at the standard rate. So if your supplier is charging you VAT, unlikely to happen, but it could happen that they might be registered for VAT, like we see with imported electronic services. The supplier may have to register and then they would have to charge VAT and issue with a tax invoice and so on. So if that's already happening, then obviously you don't have to raise VAT yourself because you've already paid VAT through the invoice mechanism. And then they specifically refer to an educational service. And that's an educational service supplied by an educational institution established in an export country, which is regulated by an educational authority. Okay, so if you sign up for a Harvard MBA or something like that, imported services, you in South Africa are making use of this educational service, but it's subject to the same regulation in the home country as we would see applying to universities here in South Africa. That's very similar to what we see coming through under the exempt supplies, but nonetheless, it has its own category over there. And then it talks about the supply of services by an employee in the course of rendering employment. And that's because the definition of enterprise in section 1 excludes any activities of an employee in the course of earning remuneration. So an employee who earns remuneration is not carrying on an enterprise and there'd be no VAT on that activity. So if you have an employee who is providing services, that is not going to fall under the ambit of imported services. Okay, but it must be an employee who is being remunerated for that service. And then finally, which is not really going to help many people, but if the value of the imported services does not exceed 100 Rand per invoice. Interesting that they say per invoice there, but you know, you're not going to, I'm sure no one's going to start generating thousands of invoices of certain amounts under 100 Rand. That's just a ridiculous scenario. But the point is that they're saying very small imported services of less than 100 Rand would not attract output tax under section 7.1c. Okay, so those are the only exclusions to this. Otherwise, imported services, to the extent, remember, imported services by definition is saying other than for the purpose of making taxable supplies. So if you're using these imported services other than for making taxable supplies, then you should be paying output tax. Now, in the SARS VAT Connect of June 2021, they make the point, we spoke earlier about a non-vendor would pay this output tax, and I'll show you the mechanism for payment just now, but it refers to the VAT 215 form. It used to be that the non-vendor would have to fill out the VAT 215 form and lodge it with SARS. Following the 2020 amendments, they no longer have to actually furnish that form to SARS, but they must complete the form and keep it, and obviously keep all the documentary evidence so that should there be a query from SARS later on, and bearing in mind that sometimes these queries can be years down the line. So it's really important to keep the documentary evidence so that if there is a query, you are able to produce the form with the related evidence documents to show that you did raise the output tax and you did pay the tax across to SARS. The way that you would actually pay the tax across to SARS, because bearing in mind, we're talking here about a non-vendor in this particular case, who's received imported services. And so you would then pay, they say, through your e-filing profile. You would just go through and select a payment type under create additional payments, tax type VAT for non-registered vendors. Okay. And so you would pay it through the e-filing system, which would then generate a receipt number. And then your receipt number you would need to insert onto your VAT 215, then attach all the necessary documentation and keep that in a safe place in case you get audited later on. If you're not registered for income tax, then they suggest you register an e-filing profile, or else they give you an email address. If you can't make use of the e-filing for whatever reason, then email SARS at importedservices@sars.gov.za for further guidance. Then you have to keep your VAT 215 form and the relevant material for 5 years. The deadline for paying this VAT, remember, if you're a vendor, you would be showing the output tax on your VAT return, and then you would pay that with your normal VAT payment. If you're a non-vendor, you've got to pay this within 30 days of the time of supply. And if you don't pay the VAT within the 30 days, you could end up with a 10% late payment penalty and interest. And SARS has the ability to raise an estimated assessment for the VAT liability. Okay, so it is an area where, unfortunately, I think many people are unaware of the obligation to make this payment of VAT. I'm assuming that pretty much everyone who's logged into this webinar are accountants. And so, you know, we don't have much excuse for not knowing the law. So we need to know this, and we need to be able to look for risk areas at clients where they might be vulnerable to this, to understating their VAT in this regard. And then obviously just try and make sure that there are, again, the necessary controls in place to ensure that the VAT is paid when it needs to be paid. Okay, let's go on to the next item on VAT, which is the Section 72 rulings. Now, Section 72 of the Vat Act was amended in 2019. Some of you might remember some of the discussion and debate that went on around the time of this amendment. Basically, what Section 72 provides is that SARS can issue a ruling as to the manner in which the provisions of the Vat Act will apply, or how the VAT will be calculated or paid in certain circumstances when a vendor or a class of vendors encounters difficulties, anomalies, or incongruities in applying the Act. So what Section 72 actually says, it says, if in any case the Commissioner is satisfied that in consequence of the manner in which any vendor or class of vendors conducts their business, trade, or occupation, if there are difficulties, anomalies, or incongruities that may arise in regard to the application of any of the provisions of this Act, and similar difficulties, anomalies, or incongruities have arisen or may arise for other vendors of the same kind who make similar kinds of supplies of goods or services, then the Commissioner may make a decision as to the manner in which the provisions are to be applied, or the calculation or payment of tax provided in this Act. Okay, so it does give the Commissioner discretion, and we talk about these as Section 72 rulings, where vendors have actually applied to SARS for rulings on they're getting permission to apply the VAT Act differently to what the provisions actually say in the legislation. Now, there were concerns in Section 72 around the constitutionality of the provision, there were various concerns that were raised. One of them was that these rulings were given to individual vendors and there was a lack of transparency. We didn't really know what rulings had been given to certain vendors. And that, combined with various other concerns, they then reworded Section 72. Now, I was reading to you from the amended version. Following the 2019 amendment, which was effective 21 July 2019, in order to get the commissioner to make a decision under Section 72, it has to be that the hardship must be similar to what is experienced by other vendors or class of vendors. You heard me reading that from this portion of the Act. So it's not just one vendor who says, I've got a problem with the Act, I'm going to go and get a Section 72 ruling. In order to get a ruling now, you would have to combine with other vendors of a similar class or in the same industry who are also experiencing similar problems in applying the Act. So that removes preferential treatment. Furthermore, SARS can no longer make a ruling regarding the application of the zero rate or providing an exemption from tax. That's on part of the no rulings list that I'll show you just now. And then a SARS ruling must not have the effect of reducing or increasing the liability, so that the actual quantum of VAT levied under the VAT Act, and cannot be contrary to the construct and policy intent of the VAT Act as a whole, or with reference to any specific provision contained therein. And then finally, in terms of the application of this new provision, the revised provision of Section 72, it says the Commissioner may publish by public notice a list of transactions or matters in respect of which the Commissioner may decline to make a decision. And we refer to that as the no rulings list. And that was actually published in notice number 300, which was published on the 1st of April this year. Not an April Fool's joke on the 1st of April. It was actually published on that date. And I'll go through that no rulings list with you, because there's quite a long list of things for which the Commissioner may decline to give a ruling. So the bottom line of it is that Section 72 has now been reworded with effect from the 21st of July 2019. There are many rulings that have been issued over the years under the banner of a Section 72 ruling, bearing in mind that VAT has been in existence since 1991. Now, so that means basically for the last 30 years, there may have been rulings out there based on Section 72. Some of them might have been issued very soon after the VAT Act came into existence. Others might have been obtained more recently. But there's a huge amount of rulings out there which were based on the old version of Section 72. When Section 72 was revised with effect from July 2019, it put a time limit on all of these rulings. So existing rulings, some of them were open-ended, they had no closing date. Those rulings are deemed to automatically expire on the 31st of December 2021. Others might expire, they might have already expired after July 2019, but before December 2021, there people would need to apply for a new ruling under the new provisions of Section 72. And if there is an expiry date, but it falls after, let's say you had a ruling that was issued 5 years ago, and the expiry date is in June 2022, but there, any rulings which are due to expire after December 2021 automatically expire 31st of December 2021. Okay, so unless you've specifically obtained a new ruling since 21st of July 2019, any other rulings are going to expire at the end of this year, and you would need to get a new ruling. And when you get a new ruling, obviously it's going to be under the new Section 72 rules, which means that first and foremost, you can't just go to SARS on your own as a vendor and apply for a ruling. You would have to go as a class action, as it were, going as a class of vendors of the same kind. So going with other vendors, and that might mean with your actual business competitors. They're the other ones who are in the same industry. Are you all experiencing the same problems with the VAT Act? Then you'd have to go together and make a class application for a binding class ruling. And you can see now I'm referring to the ATRs, the advanced tax ruling rules, in terms of the rulings that might be given as a private ruling or a class ruling or a general ruling. Now, in the VAT Connect of June 2021, they refer to binding general ruling 56 that was published on the 6th of April 2021, and that speaks about the application for a decision under section 72. Okay, so this tells you how to apply and what has to be contained in the application and what kinds of applications will be considered, etc., and what the process is. Bearing in mind that obviously we also have this list of no rulings that was published on the 1st of April. So all of this kind of happening in April 2021. And coupled with that is also public notice number 299, which sets out the fees for advanced tax rulings, including your section 72 rulings. So there's a process that has to be followed. There's certain information that has to be given depending on the type of ruling that you are looking for. There's fees that may have to be paid. And before you even get started, you would need to just check whether what you want to apply for a ruling on can actually be something that the commissioner can give a ruling for. You might have had a ruling on this particular matter before, but now it's on the no rulings list, like the issue around zero rated supplies and exempt supplies that I mentioned earlier. So notice number 300 that was published on the 1st of April 2021, the no rulings list. Now that you have to apply for a new ruling under the new section 72, bearing in mind you can't get a ruling on any of these particular things. And it talks about section 80 of the Tax Administration Act. And that is because in section 80, for the purposes of the TAA, which is broader than just the Vat Act, right? It lists a whole lot of things there where you cannot get any kind of advance ruling. And there it talks about requests for things like the market value of the asset, the constitutionality of a tax act. What else? I'm just pulling out a couple of them. Whether a person is an independent contractor, etc., or a matter that you're looking at for academic purposes. They won't give you a ruling on that. And then any regulation issued under section 74 of the Vat Act. That's part A. And then part B talks about a request to deem any of these things, a project to be a foreign donor funded project, payment in terms of a national housing program, to deem a particular payment to be a donation or grant, to deem an activity to be a welfare organization, to deem a supply to be made or not made. Now, this is interesting because to deem a supply to be made or not made, that's an extremely broad concept. So what we have is currently in the VAT Act, we have section 8, which lists our deemed supplies. And in fact, if you look at the heading of section 8, it actually talks about supplies that are deemed to be made or not made. So in some cases, it'll say it's a non-supply. But there's a whole list of things. I mean, section 8 goes on. It's got no less, I'm just having a look here to get to the end of section 8. It's got no less than 29. And in fact, it's more than 29 provisions because we've got 2A, 2B, 2C, 2D, etc. It's probably close to 35 different deemed supplies in section 8. And so the idea is that you need to use section 8. SARS is not going to give you a ruling that goes outside of section 8. All right, so they're not going to deem anything to be a supply made or not made because we've got section 8 that lists those supplies. Similarly, with all of these things, you've got a definition of foreign donor funded project, etc. And those definitions will stand. You can't get a ruling that gives any kind of variation from that. Going on from that, it also talks about the issue of a token, voucher, or stamp, whether that's going to fall into section 10, 18, 19, or 20. Now, a few months ago, we had the MTN case. I spoke about that in the May update as well. And MTN had issued airtime vouchers. And the question was whether those airtime vouchers fell within section 1018 or section 1019 of the VAT Act. And the question is, it comes down to timing because it talks about whether the voucher is going to give rise to VAT when it is issued or when it is redeemed. And if it's a general gift voucher, then it's only going to give rise to output tax when it's redeemed, when it's actually cashed in by the particular shop where you cash in the gift voucher. Whereas if it's a voucher for a specific service, then you have to raise VAT at the time that the voucher is issued. And the court held that with MTN, that was the case. It was an airtime voucher, specific voucher. You had to raise the VAT at that time. So this question of whether it falls into one of these provisions is quite important in terms of the timing of that particular supply. It's interesting because Section 10 is generally a value of supply rule, but actually it contains here a time of supply. Effectively, it's a time of supply rule because it says, for example, in Section 10(18), that when you've got a right to receive goods or services on a voucher, etc., the supply of the voucher is disregarded except to the extent that such consideration exceeds monetary value, which tells you that when the voucher is issued, you're not going to raise VAT. It's only basically when it's cashed in, it's exchanged for goods or services. And then, of course, if you had to, say, take your gift voucher and go to Woolworths and cash in your gift voucher, then obviously Woolworths would raise the VAT when you actually make that purchase. That's effectively what happens there. You don't have VAT when the voucher is actually issued. Okay, so long story basically saying that this comes back to the timing of the supply, but you would have to decide for yourself which provision that falls into. They're not going to give you a ruling on that. And then an exemption to apply on the importation of goods. So certain importations of goods are exempt from that, and they're not going to give you a ruling on that. And then branch or main business permanently situated at premises outside the Republic to be carried on by a person separate from the vendor as contemplated in Proviso 2 of the definition to enterprise. Okay, so those things SARS will not give you a ruling on. And then Part C, I did warn you this was quite a long list. Part C talks about whether you're going to account for VAT on the invoice or payments basis other than is provided for in Section 15. So you're not going to get special treatment. You just follow the rules in Section 15. Similarly, with the issue of VAT returns and making your VAT payments, either by the principal or the agent, the issue of tax invoices, etc. Input tax under Section 16(2), read with 16(3) by any person other than the vendor. So basically, they're not going to give you rulings on these things. You would have to just fit in within the normal provisions of the Vat Act. And item 5, an enterprise carried on under B5 of the definition of enterprise, and any other enterprise activity using a single VAT registration number. That's when the commissioner has the ability to group different activities together and say, well, that's deemed to be one enterprise, where people are perhaps trying to split the activities to stay under the radar screen, under the 1 million rand registration threshold. And then intermediaries for the supply of electronic services and the non-payment of VAT, etc. Okay, so there's that list of no rulings where you can't get a ruling on certain things. But otherwise, if one does want to apply for a ruling on how to, or to vary how the VAT Act is actually applied, SARS has provided quite detailed guidance that is available on their website. I've given you the live link here and with the actual address if you want to copy and paste, or if you're able to, you could just click on this link and it'll take you to the SARS website where they give you all the details for applying for a VAT ruling. And then it gives you all this additional information. They say you must submit your applications to this email address over here, and you must mark it with the appropriate heading, and you must provide full and accurate disclosure of the facts in connection with the proposed transaction, etc. Applications for VAT rulings are not submitted via e-filing, all right? And there are no costs involved in that particular case. So the VAT rulings process reference guide, again, you can click on this link if you can, or else I've copied the actual link over here, so you can copy and paste that if you want to see the process, the guide that will guide you through the process of applying for the ruling. Okay, so I'm not going to say anything further about that. I think the point has been made that the key thing is that previous rulings issued under Section 72 will expire at the end of December this year. And so if there are any vendors affected by that, they must ensure that they apply for a new ruling, and then you can't just go in on your own. You have to go in as an application on the basis of a class ruling. Okay, then the last thing I want to talk about on the VAT current developments is this issue of Property developers again. We're back there again. We've been here a number of times over the last few years, and now we are back here again because we have a draft amendment on this issue. Now, just to put this into context, to explain what I'm referring to here, we are dealing with a property developer who has claimed input tax on the cost of developing residential properties on the basis that those properties are going to be sold. So going back to this concept of input tax, where you are incurring expenditure for the purpose of making taxable supply. So the cost of development, you're developing residential properties, you're going to sell those properties, and so that's going to be your taxable supply. So the developer claims all of those input taxes, right? But then what happens is that the developer can't sell some or all of those properties, and so they start renting out the properties. Now, once you start renting out residential property, you are now have a supply of a dwelling through the letting or hiring thereof, and that is an exempt supply. And so that means you've now changed your use. You've changed from taxable to exempt. You originally thought you were going to sell this property, so you claimed all your input tax credits, but now you've changed the use of that property to renting it out. And so you now have an exempt supply purpose. And so that would give rise to a change of use adjustment. The change of use adjustment comes under section 18(1). And that requires that you are deemed to have made a supply at the time of change of use. So when you start with the rental, you've got a deemed supply, so you'd have to raise output tax on the open market value of the property at the time of the change of use. So when the rental actually commences, you have to take the current open market value times 15/115 gives you your output tax. Now, obviously, that does give rise to quite a serious cash flow implication for the developer, because they're now just getting a month-by-month rental, but suddenly they've got to raise output tax on the whole value of the unit that is now being rented out. We did have Section 18B, which was in the Vat Act for a few years, and it did give a little bit of relief to these developers. It actually gave a 3-year relief that you could rent out these properties, and the deemed supply rule was postponed and would only kick in after 3 years. So you could have a 3-year window where you could actually rent out these properties and this deemed supply rule would not come into play. But Section 8B was then scrapped from the 1st of January 2018. We did have a ruling that said that you could have entered into the last lease agreements in December 17, then of course that could give you 3 years. And so the latest possible relief under Section 18B would have expired at the end of December 2020. And I remember we discussed this last year. Okay, so 18B is now dead and gone. And it's not being brought back, even with these draft amendments that are now on the table. So there's another solution that they've come up with. But now there's another concern here, and that is that once you've had the change of use of this unit, you're no longer holding it for taxable purposes, you're now renting it out, which is an exempt supply. What happens if you then subsequently sell that unit? If you think about it, you claimed the input tax, you've raised output tax when you changed the use of that unit. So you've got the input tax, the output tax, possibly even more than what the original input tax was. So then when you eventually sell that unit, you're actually selling a unit that is now outside of the VAT net. And so there's been quite a lot of discussion about whether that subsequent sale should actually attract VAT, but then what input tax you're going to claim against that. So in BGR 55 that was issued last year in September said that the subsequent sale of a dwelling in respect of which the developer was required to have declared the deemed supply under Section 18(1) or 18B3, but of course that's now dead and gone, is not subject to VAT. Okay, so once you've taken this unit out of the VAT net because you've changed your use from taxable to exempt, the subsequent supply of that unit would not attract VAT. Even though it's a developer that is a vendor who's selling the unit, the actual unit has now been used technically entirely for exempt purposes, and so the sale of that unit will not attract VAT. But the buyer would have to pay transfer duty on the acquisition of that unit. Okay, so it doesn't affect the seller doesn't charge VAT. So that's the current state of play as we stand right now, is that we do have Section 18A that comes into play. We no longer have the 3-year window that applies. That's dead and gone. And so once you've changed the use of the unit, the subsequent sale of the unit would not attract VAT. Now what they are proposing, because obviously there's still a lot of unhappiness in the property development industry, that there's concerns around the unfairness of this. And so they have now said, well, let's come up with another solution. And the new solution that they're putting on the table that is in the proposed amendments, due to come into effect from the 1st of April next year, and that's this new Section 18D. Now, Section 18D, what it will say is that when you've got a developer who develops or holds a dwelling wholly for the purpose of making taxable supplies and then temporarily lets the property. So notice the wording here, temporarily lets the property. So you would have to be able to demonstrate that your lease agreement that you are entering into is just a temporary measure, that you haven't had a permanent change of intention, that this is just a temporary measure to provide a bit of cash flow, let's say. Okay, so in that situation, the vendor is deemed to have supplied the property, but notice the valuation rule, the value of supply rule, new value of supply rule in Section 1029 says that the consideration for this deemed supply is equal to the adjusted cost to the vendor. So instead of saying, as we have at the moment, excuse me, under Section 18.1, we say we have to use the current market value. This is saying that you have a deemed supply, but you're going to use adjusted costs. So actually what that's going to do is it's basically whatever you claimed as input tax, you're going to just now reverse that. Well, it's still, obviously you have to now pay this amount back to SARS all in one go, one lump sum. So it's still an amount that has to be paid, but at least it's not based on the current market value, it's based on the adjusted cost. The adjusted cost by definition is a cost to the vendor, including any VAT that would have been payable. So you take that total amount, and then that's your consideration. So to isolate the VAT out of that 15 over 115 of that amount is your VAT. So it's basically your input tax now that you claimed before, and now you're reversing it. The time of supply is the time that the property is applied as a dwelling. That's going to come through Section 9.6. So we have temporary change of use gives rise to a deemed supply. And then if you then subsequently sell that property, then that subsequent sale is actually going to be a taxable supply. See this here? So instead of going with what they've said at the moment, according to BGR 55, where we're saying the subsequent sale is not going to be subject to VAT, it's a non-supply. But now they say it will in fact be a taxable supply. But what you would do is your consideration will be the actual consideration for the actual sale of the property. This might be in, say, 2 years' time, minus whatever amount has been taken into account under 1029, which is this adjusted cost. So basically it would just, let's say your adjusted cost is 2 million Rand. So you bring that into account when you have the deemed supply, because you're now renting out this unit. So you would take 2 million Rand times 15 over 115 gives you an output tax at, let's say now, if that happens now. And then let's say you then sell the property in 2 years' time for 3 million Rand. So then your consideration is 3 million minus the 2 million you've already taken into account over here. So that would mean that actually it's a balance of 1 million, like your profit in essence, your markup as it were. That would be the 1 million Rand, and then you'd raise output tax on that. And the time of supply will be in accordance with our existing Section 9.3D, which applies to fixed property. And that tells us that the time of supply of fixed property is the earlier of the transfer at the deeds office or payment of any amount towards the consideration. Yeah, so I don't know. If you're involved in the property development industry, think about whether you think this amendment is going to work. Is it going to improve on the situation as it stands at the moment? If you think this is not going to help, if it's just going to cause more confusion, then please send comments through to your professional body, because there is still time to comment on these amendments up until the end of August. Okay, so that probably brings us to a good time to take a short break. Let me just quickly have a look. I see there is a... Okay, so the question here from Anthony, how does the taxpayer know who else is needing a ruling? Well, see, this is the problem. If it's a Section 72 ruling, you have to say, well, as a vendor, we know we've got a problem applying the VAT Act in a certain way. First of all, check whether you're on the no rulings list. If you're not, and you say, right, we possibly could get a ruling on this, but then you would have to look around and see what other vendors do you think are also going to have a similar problem, and then approach those vendors and ask them to team up with you with your application. That's really how you would have to do it. Okay, then Gavin has made a point. I supplied software to a company in Uganda, no VAT on export, yet they withheld 10% of the invoice value, claiming there's a taxation agreement with South Africa that imported services attract. Well, that's a Ugandan rule, okay? So it's their withholding tax that they're applying here. And unfortunately, yeah, so that's not a South African VAT issue. So you're quite correct in terms of you supplying software to a company in Uganda. So that is a zero rated supply. But what they're doing is that when they're paying you for that supply, they are applying a withholding tax, because they've probably got a rule in Uganda that says any payments that are going to non-residents for any kind of service or possibly electronic goods that are provided, there's a 10% withholding. So that's their withholding tax that they are applying here. And it's quite a difficult one. That it's what we used to have a Section 6 quin that applied to these types of taxes, but you can't use your Section 6 quat rebate for this, because it's not related to foreign income, because you're carrying on your business here. So actually what you'd have to look at here is getting a 6 quat deduction for the withholding tax that's been paid on this amount. So have a look at the 6 quat deduction, and that's an income tax thing, right? Not a VAT thing, because what's happening is that the amount that you're getting, they're withholding 10% on that. Okay, so it's not a VAT issue per se. It's actually a withholding tax that they're applying. Okay, I hope that has assisted you. All right, so let's take then a 10-minute break. It's almost 3:10. So let's reconvene at 3:20. I'll see you just now. Right, shall we carry on? I hope everything's coming through loud and clear. If not, I'm sure Stan will stop me. I'm just going to carry on so long on the assumption that it's all coming through okay. So there was one other question that came through just after we took our break, and that was from Ilan, who says, when do you use an ATR, advanced tax ruling, versus a tax directive, if the query or issue is for PAYE? Now, tax directives are very specific. So a tax directive is where you're going to vary or use a different percentage for withholding PAYE. Okay, so if you, instead of deducting according to the tables, let's say you're going to apply for a directive to withhold a lesser amount, or you might be applying to withhold a specific amount from a lump sum, for argument's sake. So that's what directives are for. It's talking specifically about the amount of PAYE that is being withheld. Otherwise, ATRs are used for getting clarity on the application of the tax law. So tax directive, in a sense, is a very little subdivision of in a sense, but it doesn't fall under the ATRs specifically. Okay, so talk specifically around the amount of employees' tax that is going to be withheld. I hope that clarifies that. If you do want to apply for a directive, the SARS has a special section on their website. If you pop into your Google search SARS directives, etc., it'll take you to their specific section dealing with directives, and they also list all the different directives. There's a whole range of them, different ones that you can apply for that apply in different circumstances, like some of them directives with your 6 quat rebate, sometimes directives relating to lump sums paid from funds or retrenchment packages, things like that, okay? And if you want to apply for an advanced tax ruling, again, SARS has got a separate section on its website where they've got a lot of information around advanced tax rulings. So if you just Google it or go onto the SARS website, you'll find it there. In fact, I see the ATR website is under the legal counsel subsection. So you go SARS, go to legal counsel, legal advisory, and then you'll go to your advanced tax rulings. Okay, so I hope that clarifies for you on that score. All right, then let's have a look at provisional tax. So the heading of today's presentation was current developments in VAT and provisional tax. But I've thrown in a little bonus for you here, also talking about an update on the VAT, the PAYE, the extension of COVID relief that was announced on the 12th of August, and the recent, or it was announced actually at the end of July, but then the second batch of amendments detailing this COVID relief were released on the 12th of August. So let me not jump ahead of myself. Let me talk about provisional tax first, and then we'll come on to the issue of PAYE. Now, in the area of provisional tax, I'm not going to go through, we don't have time to go through the whole rules around who is a provisional taxpayer, how do you calculate the basic amount, and all that sort of thing. So I'm just going to focus on the current topical issues around provisional tax, and that hinges around this question of the deferral relief that was given last year, but there's still an element of that is still carrying over. So I just want to talk about that, and then we'll talk about other issues relating to payment of provisional tax, what happens when you underpay, when can you get a remission for penalties, interest, etc. Okay, so if we look at the deferral relief that came through last year, this was the COVID-19 Disaster Tax Management Act that was promulgated in 2020, and it gave relief, remember, for PAYE and for provisional tax. It was deferral relief. Now, there's quite a lot of dispute between SARS and taxpayers around this deferral relief on both PAYE and provisional tax. This would be where the taxpayer believes that they are entitled to the deferral relief, so they've actually claimed the deferral relief, if you like, and SARS doesn't think that they're entitled to the deferral relief, and so as a result, as far as SARS is concerned, the taxpayer has underpaid the amount, and now SARS charges underpayment penalties, late payment penalties, and interest. Okay, so let's just see who was actually eligible for the deferral relief last year and how the deferral relief actually applied. And it's going to lead me into the discussion of the topical issue, which is, of course, cash flow problems right now. And what do people do if they don't have enough money to pay their provisional tax? So the deferral relief last year applied to qualifying taxpayers. For provisional tax purposes, that spoke about a company, trust, or individual that was a taxpayer as defined, that carried on a trade, and they had gross income of 100 million rand or less during the year of assessment ending between April 2020 and March 21. All right, so this went up to March 21. This has not been extended in the current batch of tax relief measures. The current batch of tax relief measures that is being put on the table now only speaks to deferral of PAYE, and it talks about the enhanced ETI, but that's it. Also, deferral of excise duty payments, but it doesn't talk to deferral of provisional tax payments. Okay, so we're talking about the year that ended 31 March 2021. And not only did we have a restriction on the amount of gross income of 100 million rand, but also how that gross income was made up. So you would have to ensure that if the person claimed the deferral relief on their provisional tax, then they had to meet the criteria of being a qualifying taxpayer. So their gross income could not exceed 100 million, and the composition of gross income was such that they did not derive more than 20% of their gross income in the form of interest, dividends, foreign dividends, rental from letting fixed property, unless that was their main business, and any remuneration. So when you look at gross income of a taxpayer, first of all, it must not exceed 100 million. Then you would say, right, gross income is made up of different components. Notice we look at gross interest. So before any exemptions, gross interest, gross dividends, gross foreign dividends, gross income from letting fixed property, gross income from remuneration, add all of that together, that cannot comprise more than 20% of your total gross income. Okay, so in essence, what they are driving at is they are looking at taxpayers who are not getting mainly remuneration or investment income. They are earning trade income, as it were, because, you know, the rest of this would have to be active trade income. Okay, and then the final requirement, and this seems to be the one that's putting a bit of a stone in the shoe as far as this process is concerned, is that the person had to be tax compliant, as referred to in section 2563 of the TAA. Now, to be tax compliant as referred to in the TAA means these things. You have to be registered for everything that you should have been registered for. There's no outstanding debt other than debt that is under management with SARS. So you've also already entered into payment arrangements under section 167, or you've entered into a compromise agreement with SARS under section 204, or you've applied for a suspension of payment under section 164, where there's a dispute with SARS. And before you lodge your objection, you apply for a suspension of payment. Remember also that suspension of payment, from the time that you lodge your request for suspension, SARS may not take steps to collect the tax from that time up until 10 business days after that suspension falls away. So either they've notified you that they're not giving you the suspension, or the suspension has been revoked because you lost your dispute with SARS. So while you're under the umbrella of section 164, that is what we call debt that is under management, and that doesn't count as outstanding tax debt. So that would not cause you, that debt that you've applied to have suspended is not regarded as outstanding tax debt for the purposes of being tax compliant. In other words, you can still be tax compliant even though you've got outstanding tax debt because you've applied for the suspension of payment. Now, sometimes this doesn't always work properly. It can be that you've applied for the suspension of payment, SARS has just ignored your correspondence, and so as far as they're concerned on their system, you are shown as having outstanding tax debt. That's a really unfortunate and unacceptable situation, because you have followed process by applying for the suspension of payment. That means that the tax debt should not be counting against you as far as your tax compliance status is concerned. You see, because that's going to make a very big difference. If it is counting against you, if you're shown as not being tax compliant at the time that you apply the deferred payment arrangement of your provisional tax, if SARS says that you have outstanding tax debt, they're going to say you're not entitled to the deferral. And then they're going to say that you've underpaid your tax and you end up with a late payment penalty. And this seems to be happening to many, many taxpayers. Then the other situation where you might have tax debt, but it shouldn't count against you for compliance status reasons, is if your tax debt does not exceed 100 Rand. Again, it's not going to help a lot of people. So your tax compliance is registration, tax debt, and no outstanding return. Return refers to any type of return. Income tax, employees tax, VAT, any kind of return that should have been submitted, can extend to skills development levy returns, UIF returns, etc. Those are all returns. And so if you have any outstanding returns, it means you're not tax compliant, and you would have to check the compliance on the date that the taxpayer submits the return and claims the relief. So if you're talking about provisional tax, if they were claiming the relief on the second provisional payment that would have been made at the end of March 2021, on that day that they claimed that relief, were they tax compliant? That's what you're really looking at. And if they were tax compliant, they were eligible for the relief, as long as, of course, that they met the other requirements of being a qualifying taxpayer. And if they didn't meet these requirements, then they were not eligible for the relief. So the relief, remember, was a deferral of 35% of the provisional tax. So at the 6 monthly point, first provisional, instead of paying 50%, you only had to pay 15%. Second provisional, instead of paying the whole amount of tax at that point by the last day of the year of assessment, you would, submit your estimated taxable income. What is the tax liability on that? Then normally you would subtract what you had paid for your first provisional, subtract any employees tax, and the balance is what you pay. But if you were eligible for the deferral relief, then you would instead submit your estimated taxable income, work out the total tax liability, multiply that by 65%, all right, and then take off any employees tax, first period payments, etc. And so in effect, 35% of your tax liability could be deferred. Now, if you had a March year end and you then only had to pay 65% instead of the whole amount by the end of March, the other 35% gets deferred until the time that you would normally make your third provisional payment. Now, if you had a March year end, your third provisional payment would be 6 months later, which would be the end of September, right? And so this deferred amount must be paid by the end of September 2021. If you had a February year end, add on 7 months, it also takes you to the end of September. Okay, so whether you have a February or March year end, this deferred amount must be paid by the end of September. Don't be fooled by the fact that the third provisional payment is a voluntary payment, it's a topping up payment. This deferred amount, it's not voluntary. You have to settle it by that date, 6 or 7 months after year end. So February, March year ends, you have to settle this amount. Whatever deferred amount there was must be settled to SARS by the end of September. Now, as far as your normal provisional tax is concerned, you would have then done your second provisional by the end of the year of assessment, and then you can make the topping up payment. Remember that the 89 quart interest kicks in from the day after the effective date. The effective date is that date 6 or 7 months after year end. So February plus 7, end of September, March plus 6, end of September. If, let's say, your estimated taxable income on the last day of the year of assessment was 5 million rand, but it turns out that your final assessed taxable income, or by the time you get to the end of September, you know that actually your taxable income is going to be 8 million rand, all right, then you would basically that the tax on that extra 3 million rand, if you don't pay it by the effective date, then 89 quart interest kicks in from the day after the effective date. Now, if this deferred amount of 35% is not settled by due date, then that becomes an outstanding tax from the first day after the effective date. And then there would be late payment penalties that it could apply. And again, there'll be interest that is charged from the first day after the effective date on that whole amount that is still outstanding. So if, for example, you had estimated taxable income of 10 million rand, and that was your estimate for both the first and the second provisional payment. By the time you got to the second provisional payment, let's say end of February 2021, you would say estimated taxable income 10 million, tax 28%, 2.8 million. I have paid my first provisional payment of 420,000. That is reduced because I made use of the deferral relief that was on offer, I deferred, and I've paid 420,000. So I'm now going to pay 1.4 million. So in total, by the end of February, I've paid 1.4 plus 420, I've paid 1.82 million. But you can see the tax on 10 million, based on your second estimate, is 2.8 million. So that extra 980,000 is the deferred amount that must be paid by the end of September. So this date is coming up pretty soon, right? End of next month. These deferred amounts must be paid. Now, the sad thing is that many of the businesses that had cash flow problems at the end of February or March have just the same, if not worse, cash flow problems now. And so this now becomes an issue as to what's going to happen about payment of this deferred amount. Now, of course, if you just leave the deferred amount and you don't pay it, as I say, that becomes an outstanding tax debt from the first day after that. So your due date for payment, 6 or 7 months after year end, let's say end of September, the amount's not paid, you now have an outstanding tax debt. And then SARS is going to start taking collection steps to recover that debt. So it's far better that if you envisage that you're going to be in a situation where you can't pay that deferred amount, that you apply for payment arrangements with SARS, making use of Section 167 and 168 of the Tax Administration Act, in terms of which SARS is permitted to enter into an agreement to make payment arrangements with a taxpayer. But they do have to take certain things into consideration. So when you approach SARS to apply for payment arrangements, you need to put on the table and satisfy them that these considerations will be taken care of. that the taxpayer suffers from a deficiency of assets or liquidity now, but that's reasonably certain to be remedied in the future. That they anticipate income or other receipts in the future, which they'll be able to use to pay the tax debt. That the prospects of immediate collection are bad, but they are likely to improve in the future. So give them some information to satisfy them on these things. Also, that the collection activity would be harsh in the particular case, and the deferral or installment agreement is unlikely to prejudice tax collection. Remember, they have to protect their debtors book, and they need to be sure that they can still collect. So give them some assurance, something that's going to indicate to them that you can't pay now, you don't have the cash to pay now, but indicate what's likely to change in the future to make it possible to pay this amount in the future. And then, of course, SARS does like to have taxpayers providing security, so they may require that from the taxpayer. If you want more information, please do have a look at the SARS website. Click on this link. They've got quite a lot of information about applying for payment arrangements and some kind of relief when you know that you're going to have a problem meeting your tax obligations. Remember that the penalties as far as provisional tax is concerned, you've got your late payment penalty that can apply to both your first and your second provisional payment. So even 6 months into the year, and this is the problem when people have claimed the deferral relief. Let's just go back to my example here. So if they claim the deferral relief and then they only paid 15% instead of 50%, so they've deferred this amount. 50% would have been 1.4 million. They've paid 420,000. They deferred 980,000. The problem is that SARS, if they are of the view that the taxpayer is not eligible for that deferral, then as far as they're concerned, you should have paid by the end of August 1.4 million. You've only paid 420,000, so you've underpaid. Then they want the 10% penalty on this. And then you get to the second provisional, you end up with the problem again. And so, yeah, I mean, it's a real concern. And I've noticed that the Tax Ombudsman has been dealing with many problems with taxpayers where they've claimed deferral relief, whether it be provisional tax or PAYE, and then they end up with a disagreement with SARS as to whether they were actually eligible for the deferral relief. So you go back to the facts around what is a qualifying taxpayer? Was this taxpayer a qualifying taxpayer? Did they meet all the requirements? Yes or no? Okay, so, and if they didn't, then you need to pay in that amount that you thought you could defer. Obviously, if you're not eligible for the deferral, then you need to pay that amount back to SARS. Okay, so this 10% late payment penalty, we know all about that. It's been around for a long time, and it's deemed to be a percentage-based penalty under Chapter 15 of the Tax Administration Act. Of course, the other type of penalty is your underestimate penalty, and that only applies to your second provisional payment. So that applies with the estimate that you have to provide by the last day of the year of assessment. And remember that there are rules around that estimate. So it links to whether your taxpayer has final assessed taxable income above or below R1 million. I'll come back to the failure to submit just now. So if you've got a person with final assessed taxable income not exceeding R1 million, then basically your second estimate should not be less than the lower of 90% of final assessed taxable income or the basic amount. So the basic amount does still feature there if you have a taxpayer with taxable income less than R1 million. Okay, so the penalty basically says, right, if you had submitted your estimate in line with this requirement, not less than the lower of 90% of taxable income or the basic amount. So take the lower of those two figures. How much tax would have been payable based on the lower of those two figures, minus whatever tax has been paid up until the last day of the year of assessment. Then basically, had you got your estimate right, you would have paid the right amount of tax. But now you've underestimated, you've come in below the lower of those two figures, and therefore you've paid your tax based on your lower estimate. So you've underpaid your tax. And so now basically you take the difference between what should you have paid had you used the proper rules minus what you have paid by the last day of the year of assessment, and that underpayment times 20% is the amount of the underestimate penalty. Okay, so again, that is deemed to be a penalty charged under Chapter 15 of the Tax Administration Act. If the taxpayer's taxable income was above R1 million, then you can't use the basic amount. And your second estimate, and this becomes really tricky, is that your second estimate must be 80% accurate. So again, the penalty looks at what should your payment have been had you come in with the right amount of the estimate, all right, and minus what have you actually paid. Now, you've paid less because you thought your taxable income was going to be less than what it actually is. Let's have a look at this example over here. If we said that your final assessed taxable income is 1.5 million, so your second estimate should not have been less than 80% of that 1.2 million. Now, of course, this is taking future events into account. We're saying final assessed taxable income, that can be a year after your end of your financial year that you finally know that number, because the deadline for submission of the tax returns for companies is 12 months after year end. So that's when you know that your final assessed taxable income is 1.5 million rand. But on the last day of the year of assessment, you should have made sure that your estimate was at least 80% of that. So you should have come in with an estimate not less than 1.2 million. And had you used that estimate, you would have paid tax at 28% for the year of 336,000. Minus what have you actually paid by the last day of the year of assessment. So you've paid based on your estimate. Maybe you estimated your taxable income was going to be R1 million. So you've paid by the last day of the year of assessment. That's a combination of first and second provisional payments, 280,000. So you've short paid by 56,000 and the penalty is 20% on that. Okay, so the penalty can amount to a substantial amount of money. And of course, it gets really tricky, especially with your taxpayers whose taxable income is above 1 million rand, because you have no reliance on the basic amount. At least with taxpayers below 1 million rand, they can still have some reliance on the basic amount, which links back to the last assessed taxable income. So it gives you a little bit of maybe some kind of safety factor. But once you go above 1 million, the expectation is that you have a good way of estimating your taxable income. And so they expect you to get it within 80% accuracy by the last day of the year of assessment. Now, then the question is, of course, so then what happens if you've underestimated and now you end up with this penalty, in this case of 11,200 rand. So in terms of the fourth schedule, there is an inbuilt remittance provision that says that SARS can remit the penalty if you're able to show. So it actually says here that the commissioner must be satisfied. So you must satisfy SARS, right? That the estimate was seriously calculated with regard to relevant factors and was not deliberately or negligently understated. So if you are facing this challenge of applying to SARS to remit that penalty, you're going to apply motivating to them, and not just using these words, but motivating to show them that you actually did take into account all the relevant factors and that your estimate was not deliberately or negligently understated. So you would motivate. How is it that you came to your estimate? What factors did you take into account? And of course, specifically, what changed? What changed to cause you to end up with your underestimate? Going back to my example over here, you thought your taxable income was only going to be 1 million rand, all right, but it ended up being 1.5 million. So what changed between the last day of the year of assessment and when you actually did your final tax calculation that you ended up being short on your estimate? I mean, sometimes there are specific things that can change, like capital gains tax calculations, or perhaps even debtors, that you've written off debtors, claimed them as bad debts, and then they end up paying you out of the blue. So then you reverse that bad debt write-off. So things like that, things can change. Sometimes foreign currency transactions might come into play. Who knows? There are various things that can come into play that can cause your taxable income to be higher than what you thought it would be when you did your second provisional estimate. But you would have to motivate. What changed? What was it that changed that you could not foresee when you did your second estimate? And then put it on the line that you did not deliberately or negligently understate that estimate. And then motivating for that, you would have some success of getting that penalty remitted. Notice also that if you end up with an underestimate penalty and a late payment penalty for the same provisional payment, then you can't pay two penalties on the same offence. And so the underestimate penalty must be reduced by the late payment penalty. So that's something just to check on to make sure that there's not a double penalty coming through there. Now, the other situation is where the taxpayer fails to submit a second estimate. We used to have a separate penalty for this, right? But now, as of a number of years ago, they've actually incorporated this into the underestimate penalty. So how it reads is that if your provisional taxpayer has not submitted their second estimate within 4 months after year end. Now, it's not giving you an automatic extension. You still have to submit your second estimate by the last day of the year of assessment. However, if you haven't submitted still 4 months after that time, then you're deemed to have submitted an estimate of nil. So they assume that they deem you, all right, it's this magic provision in the Tax Act that creates what has been referred to as a statutory fiction, but it becomes a very big reality when it translates into a tax liability, that you are deemed to have submitted an estimate of nil. So by submitting an estimate of nil taxable income, then you would look at what is your final assessed taxable income. Is nil less than your final assessed? If it is, then you've got an underestimate. And then you go back to looking at the underestimate penalty. What would the tax have been if you had put an estimate in for the correct amount, minus what tax have you actually paid by the last day of the year of assessment, and the shortfall times 20% is your underestimate penalty. Okay. In that particular case, SARS may remit part or all of this penalty, which arises from a deemed nil estimate, if they are satisfied that the failure to submit the estimate was not due to any intent to evade or postpone the payment of provisional or normal tax. So if you end up with an underestimate penalty linked to this failure to submit an estimate, then your grounds for remittance are different to the normal underestimate penalty, right? So here you would be motivating to SARS that your failure to submit, you'd have to explain why the taxpayer did fail to submit, and clarify that it was not due to any intent to evade or postpone the payment of provisional or normal tax. Okay, so those grounds for remittance, they are really important in terms of the fourth schedule, that we have those internal grounds for remittance, and those are the grounds of remittance that you would use if you are trying to get your underestimate penalty remitted. Of course, in both cases with the late payment penalty and the underestimate penalty, I said there that those are deemed to be penalties under Chapter 15 of the Tax Administration Act. Percentage-based penalties under Chapter 15. Now, for percentage-based penalties, Chapter 15 has its own remittance rules. So apart from what we mentioned with the fourth schedule, we've got remittance rules under Chapter 15. And for percentage-based penalties, it tells us that SARS may remit the penalty or part thereof if they are satisfied that the penalty has been imposed for a first incidence, which means you've had no similar penalty assessment in the last 36 months, no penalty assessment, other than penalties that were fully remitted under the Section 218, which talks about extraordinary circumstances. Okay, so if you've had a clean record over the last 36 months and now suddenly you have a problem, that would be a first offence, or alternatively, it involves an amount of less than 2,000 Rand. So these are extremely limited grounds for remittance. But remember that you have got the specific ground for remittance in the fourth schedule that I covered just now. In addition to being either a first offence or an amount less than 2,000 Rand, you also have to motivate that you've got reasonable grounds for non-compliance and that the non-compliance has been remedied. So like with a late payment penalty, by now you must have made that payment. It's no good applying for the penalty to be remitted if the actual payment is still outstanding. So you must have remedied the non-compliance. Okay, unless you're not liable for the penalty or there was a SARS error or the taxpayer has since died. Okay, so that's the ground for remittance under Chapter 15, Section 217. And then finally, there's another grounds for remittance which becomes particularly topical in our current scenario and recent events in South Africa. And that talks about remittance in exceptional circumstances. This speaks to all penalties that are covered by Chapter 15, which is your administrative non-compliance penalties, failure to submit an income tax return, There you've got your fixed amount penalties, and then also your percentage-based penalties. As I've mentioned, your late payment penalty and so on. It does not apply to understatement penalties, because understatement penalties are levied under Chapter 16. Okay, so this is still under Chapter 15, but your percentage-based penalties under Chapter 15, it may be that exceptional circumstances might come to your rescue. So in terms of Section 218, SARS must, upon receipt of a remittance request, remit part or all of the Chapter 15 penalties, that's any of these Chapter 15 penalties, if any of the following circumstances rendered the person incapable of complying with the relevant obligation. Now notice here, it's not enough to just say there were exceptional circumstances. You have to show that one of these exceptional circumstances existed and caused the person to be incapable of complying with their obligation. So if they've failed to pay their provisional tax on time, or failed to pay their VAT or their PAYE on time, or failed to submit their income tax return on time, if that non-compliance was due to one of these exceptional circumstances, and you'd have to motivate this in your request for remittance. But then that's a special situation where SARS could remit the penalty. And so let's just run through them. And I've also included in brackets examples which have actually been provided by SARS. This comes from the SARS website. So the first part is the wording of the Tax Administration Act. And then what is in brackets is the example that was on the SARS website. So natural or human-made disaster like theft, hijacking, or elements of nature like fire or floods. Civil disturbance or disruption of services. Just think back to the events of July in KZN and Gauteng especially. So they give the examples of strikes, marches, and riots. Serious illness or accident. Well, we don't have to think too far for that one, with serious illness, with the amount of COVID going around, but also talking about serious emotional or mental distress. And they give the example of hospitalization. Maybe the person dealing with the tax affairs was seriously ill, and that's the only person working on the tax affairs. Nobody else has access to the records or to the e-filing system to actually make the payment. Serious accident, stroke, death, etc. So that comes into that realm of exceptional circumstances. Errors by SARS, which is a different context to what we're thinking of at the moment with the COVID and the strikes. But errors by SARS can come into exceptional circumstances. And then serious financial hardship in itself is regarded as an exceptional circumstance. So if you've got an individual who is facing a lack of basic living requirements would be basically food and shelter. So in other words, to take it to the extreme, if you had to pay your provisional tax, you're going to have no money to provide food for your children. I mean, obviously, it would have to be quite a dire situation here. It's not just a case of, well, we can't get McDonald's, but, I'm being a little bit flippant about this. But the thing is that there can be situations where there's actually a threat to basic living requirements. So that would fall into the realm of exceptional circumstances. Or in the case of a business, if there's an immediate danger that the continuity of the business operations and the continued employment of its employees are jeopardized. So if you're facing a situation where you've got this deferred provisional payment, you deferred it at the end of March, now it's hanging over you that you have to make this payment by the end of September. But if you make this payment, it means that you would not be able to pay the wages of your workers. You'd actually have to lay them off. That is obviously this type of financial hardship that is being considered here. So then, ideally what should happen is you should then approach SARS to make payment arrangements before you get hit with a late payment penalty. But if it transpires that you hadn't made payment arrangements, then you get the late payment penalty, there is grounds for remittance under these exceptional circumstances or any other circumstance of analogous seriousness. Okay, so I think with the current situation, and even though I say current, well, we've been under COVID for longer than 500 days now, but also we've had these serious strike conditions, and there's just a lot of stuff going on. People are facing some horrendous situations, farmers, etc., and even other businesses, being pillaged and set alight and all sorts of terrible things. And so it might happen that all of the person's records have been destroyed And even though they might have a way of recovering that in time, but maybe at the time that their payments had to be made, they were not able to make those payments on time, ending up with late payment penalties, then have a look at Section 218 in terms of applying for these penalties, relying on this situation of exceptional circumstances. But remember that it's not enough just to say, remember the strike in July. You have to show how that rendered the person incapable of meeting their obligation. So there was a recent article, actually last year, PwC wrote this article in the context of COVID and so on, talking about exceptional circumstances. And I thought they made a very good comment that is worth repeating here, giving them credit for it. That exceptional circumstances are defined in Section 218 to include, amongst others, natural human-made disasters, the ones that I've just read through. And they say, in our view, the term natural disaster would likely be interpreted to include the COVID pandemic, and the pandemic may also involve disruptions in services. So even that in itself can possibly, there are circumstances where it could fit under the banner of exceptional circumstances. But remember that you must demonstrate that link between the fact that there were these exceptional circumstances and how did they prevent the taxpayer from meeting their obligation. So it's still very important for you to demonstrate this clear causal connection between the pandemic or the strikes or whatever it might be and the inability to meet the person's obligations by making timeliest payment, etc. Okay, so requesting a penalty remittance. Obviously, you're looking at the request for remittance there, or you're going through the objection process. And remember that disputed penalty for late payment and related interest, you're going to use the request for remittance. If you're looking at the underestimate penalty, many times that only comes through on your actual assessment, and then you're going through the objection process. So it depends on the type of penalty that you are dealing with. Notice that your request for remission, where you are using it, can be used for both a request for remission of penalty and interest in certain circumstances. So when you talk about interest, there's mainly two types of interest that we look at with provisional tax. So the one is when you've actually paid your provisional tax late, and this can also apply where you pay your PAYE late. Then you've got 89 bis interest, and that kicks in at the current prescribed rate, which is 7%, and it's on the unpaid amount. So you should have paid a certain amount by such and such a date. You've now got a late payment, you've got your 10% late payment penalty, and you've got interest on that amount calculated from the end of the relevant period, like 6 months into the year end, by the end of August, up until the time that you actually make payment. All right. Now, the actual mechanism of paying the interest in some respects is quite similar with 89 Quat, although 89 Quat is talking specifically around how much provisional tax or how much tax liability is still outstanding after you've made your third provisional payment. So that's where the third provisional payment comes into play, is that it can save your 89 Quat interest. So again, it's charged at the prescribed rate of that 7%, but from the day following the effective date up until the assessment is raised. So if you have March year end, you've got up until the end of September to make your third provisional payment. If there's still tax liability outstanding, so you look at your final assessed taxable income times 28% if it's a company. What is your final liability minus what was paid up until the end of September, first, second, and third provisional, and whatever balance was outstanding after that date is going to carry interest, 89 Quat interest at 7%. That's, of course, if your taxable income is above these thresholds, 50,000 for individual or trust, 20,000 in the case of a company. Now, there are grounds for getting the 89 Quat interest remitted. 89 Quat 3 says specifically when the commissioner is satisfied that the circumstances are such that the interest was payable as a result of circumstances beyond the control of the taxpayer. All right, so you've basically not made a sufficient third topping up payment, and that's triggered the 89 Quat interest, and the interest becomes payable because of circumstances beyond the control of the taxpayer. Now they don't clarify really exactly what that means. It's basically up to interpretation. It's very much dependent on the facts. But if you're able to show that there are circumstances beyond the control of the taxpayer, which might link to those exceptional circumstances that we spoke about earlier, then you could motivate possibly that there should be a remittance of the 89 quat interest. There's also another one that applies to individuals in the first year of being a provisional taxpayer, that if they don't make the sufficient topping up payment of the third provisional payments, and so they end up paying interest, 89 quat interest, in the first year that they're a provisional taxpayer, you can apply to get that interest remitted, if the commissioner is satisfied that the circumstances warrant remission. All right. So you would have to motivate for that accordingly. Okay, now, as I said earlier, if you want to request a remittance of the interest, you're also going to do that on the RFR 01 form. If the commissioner turns down your request, that is subject to appeal. And so you can go on to objection and then possibly later on to appeal. But bear in mind that SARS cannot waive the interest more than 3 years after the date of the assessment, or 5 years from the date of a self-assessment. Okay, so that's on the provisional tax. I just want to quickly pick up and see if any of these questions can be answered now. So yeah, Ren, you say regrettably SARS very seldom responds to the objections and a Section 164 application. That is just really extremely concerning. And sadly, one does hear about this so often. But of course, the issue is that they have a period of time in which they have to respond to correspondence. And if they haven't responded within the due period, then I really do recommend that you sort of take proactive steps. So go through the complaints mechanism and give them the requisite period of time. If they don't respond within that requisite period of time, then you report it on to the tax ombudsman. All right, because it is really important that we don't let these matters lie, and that we don't just allow these things to sort of languish in the SARS system. And the thing is that if you don't take specific action, so you don't go through to the SARS complaints mechanism, and then you don't go through to the tax ombudsman, it becomes very difficult later on to then take action to rectify these things. So I know it becomes a bit of a bind, but it's really important to basically, stay on SARS all the time. Don't let it lie, and don't let it go unnoticed if they don't answer your correspondence. Okay, and then on the other questions, sorry, it's disappeared onto my other screen, so I'm just peering around the corner here. Can a third provisional be submitted? Yes, I'm not quite sure the reason for that question. We have been talking quite extensively about third provisionals. And yes, a third provisional can be submitted, but remember, it's a topping up, and it's not going to help you as far as your underestimate penalties are concerned, but it can help you in terms of your Section 89 quat interest. Okay, and then following up from the previous question Ilan has asked, so he was asking about directives and tax rulings. Individual client invested in a 12J. As a result, will get a large allowance, resulting in no tax being payable. I want to apply for a directive so his employer will not deduct any PAYE. Yeah, look, I mean, the directive that you would apply for, there would be a hardship directive, which is allowed, and I can't say that they will grant it in this circumstance with the 12J investment, but it is your only possible route to look at, is the investment granted in terms of paragraph 10 of the 4th schedule. And there's a specific directive, the actual number escapes me now, that is used not specifically for 12J, but for these hardship directives, to say that the person is going to be unnecessarily prejudiced if you withhold the full amount of PAYE. You see, the 12J investment is not specifically a deduction that the employer is allowed to take into account when calculating employees' tax. So the correct amount of employees' tax is calculated without taking into account the 12J. But as I say, your only port of call then is to make use of paragraph 10 and apply for a directive under the banner of a sort of a hardship directive. Okay. And yeah, can you get a ruling? I doubt they're going to give you a ruling on that. But you can ask SARS, but I don't think that they're going to give it to you. Okay. Right, let's go on to the next slide. Now, what I'm going to turn to, and this is your bonus inclusion, doesn't fall under the banner of provisional tax, but I thought we have to cover this, right? Because it's really relevant at the moment, is the latest batch of COVID relief. And so this is the second batch. It was the announcement that was made at the time that we had the further lockdown announced towards the end of July. And then, of course, building on from that, we also had those terrible protests and incredibly destructive action that was taken in July, especially in KwaZulu-Natal and in Gauteng. And so when you look at the actual draft amendments that have been released, they actually make the statement in there that this relief is given not only as a further means of relief for the COVID-19 pandemic, but also as government's means of assisting businesses who have to try and recover from the losses that they suffered during that strike action. So there's two specific areas of relief we're going to talk about. The one is the enhanced ETI, which is basically taking exactly what happened last year with the ETI and just putting it back on the table for a 4-month period. And then the PAYE deferral relief, which again is taking what happened last year, putting that back onto the table, but for a 3-month period. Okay, so in order to qualify, again, you've got this general tax compliance requirement. I mentioned this earlier, we ran through this earlier. So please be careful that the person is tax compliant before they make use of the deferral relief. As far as the enhanced ETI is concerned, as I say, for the 4-month period, August, September, October, November, it's 4 months. As long as the employer is registered as an employer, they must have been registered by the 25th of June. And then they would be eligible for this extra 750 Rand per month. So if you've got employees who are eligible for the ETI, then whatever they're eligible for, you would add on an extra 750 per month per employee. And if they're not eligible for the ETI, maybe because they are over the age of 29, or maybe they fall within 18 to 29, but they've been employed for longer than 24 months, so they're not eligible under the ETI Act. So for those employees, as long as they are earning remuneration of not more than 6,500 Rand per month, so it's your lower income earners, but it can cover employees all the way up to 65 years of age. Then you get the additional 750 per month. So they don't get the normal ETI, but they just get the 750 per month. Now, notice that's on the basis that the employer is required to work 160 hours per month. If they're working less than that, then you prorate. So if they're working 80 hours a month, you'd get 375. Okay, so they don't have to be working 160 hours per month, but if they're working less than that, as I say, you need to prorate the ETI, the enhanced ETI. And then there's an anti-avoidance provision. So there's a sort of an additional liability for the employer if they're paying less than the minimum wage. And so if there's no national minimum wage that applies or no legislated minimum wage for the particular sector, then we look at 2,000 Rand per month. The other thing is that the ETI, as we saw happened last year, and this is coming back again, is that for this period, August, September, October, November, you can claim the ETI on a monthly basis. You don't have to wait until you do your 6-monthly EMP 501 reconciliation. Of course, the problem is, now, of course, the first ETI should be claimed for August, so it should affect the PAYE that you have to pay to SARS on the 7th of September. But many payrolls have not implemented this yet because they're waiting for the legislation to be gazetted. I mean, we've only just had the draft legislation released on the 12th of August, and they say it's open for comment until I think it's 28th of August. So it's certainly not going to be gazetted by the end of August, maybe by some miracle during the course of September, but I suspect maybe even later than that. So yeah, it's a bit of a problem in terms of your payroll systems that if they're not going to build this in until the legislation is gazetted. I don't know. I can't speak for the payroll developers. You would have to speak to them and find out, when they're going to update your payroll software. I do think it's really important to have payroll software, especially when you're working with things like ETIs and so on. It becomes just incredibly complex to try and do this on a manual system. So how do you actually claim the ETI? This is basically just picking up from last year and using exactly the same methodology that you claim it on the EMP 201. So if, for example, you had 3 employees, one was eligible for an ETI of 1,000 per month, that employee now gets an extra 750. Other employees, you had one that was 27, but he's been employed for longer than 24 months, so he's no longer eligible for the ETI. And the other is 34, so they're more than 29, so they're not eligible for the ETI. So there's no ETI, but for this 4-month period, they get the additional ETI. So basically what would happen if this was for the month of August, you would claim total ETI of 3250 in this particular case. Now, so how does that actually work? So that is taken as a credit against your PAYE liability for August. So you would pay less PAYE to SARS. So it's basically a cash subsidy that works on an employee by employee basis. As I say, for your lower income earners, people who are earning not more than 6,500 Rand per month, there is a formula that is used that is in the draft legislation. Haven't put that all into the slides here, but basically it goes according to a sliding scale. So when the person, gets towards the 6,500, the additional ETI that they would normally get comes down to naught. But this 750 is the additional ETI that you would get per employee. When is it paid? They say that if your ETI is more than the PAYE liability, so you end up in a refund situation, they promise to pay that within 10 days after the EMP 201 has been successfully processed. But notice that if you're non-compliant, if you're not tax compliant, then you're not normally entitled to the ETI credit anyway, so that would then be carried over. You're not going to get paid out the ETI credit if you're not tax compliant. Must the additional ETI be included in the IP5? The answer is yes. And I think you've all seen this from last year's process. So I'm not going to spend any more time on that. So it's exactly the same process as you saw last year, but it's just being rolled out again now from August to November this year. Okay, then we look at the PAYE deferral relief. And again, this applies to qualifying taxpayers. Now here, of course, we are now looking at the new batch of deferral relief, which comes into an amendment to the Disaster Relief Act. And so they basically say it's a company, partnership, trust, or individual, because any of those who are employers as defined, and they are registered as an employer. Remember, I said that they must be registered as an employer by the 25th of June. They must be earning gross income of 100 million Rand or less. That's for years of assessment ending between April 21 up to March 2022. Again, you've got this limitation. You can't get more than 20% of your gross income from investments and remuneration. And you must be tax compliant. All right, so I spoke about the tax compliance issue. You must be tax compliant at the point that you claim the relief. So if you're claiming the relief for 3 months, August, September, and October, each time you claim the relief. So August, you're due to make your PAYE payment 7th of September. If you're going to defer, then when you make your PAYE payment, you claim in that deferral. At that point, you must be fully tax compliant as per Section 256 of the Tax Administration Act. Okay, so your deferral basically is that you only pay 65%, you defer 35%. So if your PAYE was, let's say a million, let's say 100,000 Rand for the month, instead of paying 100,000, you're only going to pay 65,000 and you're going to defer 35,000. Okay. And you would do that for August, September, and October. It's for the 3 months, August to October. It's a bit confusing because the ETI is 4 months, but the PAYE is 3 months. This is because if you look at how it's going to be repaid, they've made provision for you to repay the deferred amounts over 4 months. So here we go back to 4 months again. And the way that it's worked out is so that your final payment is made 7th of March next year. So that's when your February 2022 PAYE and your final payment of your deferred amount is all settled by the 7th of March. So it's all basically settled in time for your EMP 501 reconciliation for the period up to the end of February. Okay, so the deferral applies, and that's only applicable on the PAYE declared on the original 201 return. If you go and change that return, that's going to cause problems as far as the deferral is concerned. So the way that you do this, again, it's exactly a copy and paste of what happened last year, is that when you submit your EMP 201, you still show the full PAYE liability for that month on the 201. But when you pay the amount to SARS, if you're eligible for the deferral relief, you only pay 65%. SARS should pick up on their system that you're eligible for the deferral relief so that they don't have the other 35% showing as outstanding tax liability. therefore incurring penalties and showing you as non-compliant, but they would indicate that that is an amount that is subject to the deferral relief. And of course, you would bank that for August, September, and October, and then add all of the deferral relief together. Then you divide by 4 and you start paying that back in 4 equal monthly installments. Remember that the deferral only applies to the PAYE. It doesn't apply to the SDL or UIF, and we don't have any SDL holiday like we had last year. Okay, so if you pay your minimum PAYE late, you're no longer tax compliant, so you forfeit the benefit of the deferral relief. And what they suggest is that you check your statement of account 48 hours after submitting your 201 to ensure that SARS has not revoked the deferral relief. That's quite important, because you leave it there, then suddenly you get a shock a few months later that you end up with this outstanding tax liability. And that just causes compounded problems, as you can imagine. So check your statement of account to see that SARS is on the same page as you, that the person is actually eligible for that deferral relief. So, for example, if you had employees tax for August 500,000, instead of paying the whole 500,000 on the 7th of September, you're only going to pay 65%, you're going to defer 175,000. And if that happens again in September, again in October, then over those 3 months, you've deferred 175,000 times 3 is 525,000. So now you've got to start paying that back in 4 equal installments. So divide that by 4, 131,250. The first amount in December, then the next one, January, February, March. Okay, so the amount 7th of March, that is, as I say, that coincides with the payment of your February PAYE liability. So by the time you get to the end of the tax year and the settlement of the resulting PAYE on the 7th of March, you're now all fair and square with SARS and you've paid back the deferred PAYE. Okay, so that's the deferral. Just very quickly, and I'm not really going to talk about these matters because this is PAYE and we were really here to talk about provisional tax and VAT, that EMP 501 returns had to be in by the end of May for the period running up to the end of February. And of course, SARS did warn that if the returns were not in on time, fully reconciled, etc., that they were going to start introducing the penalty applied under paragraph 14 of the 4th schedule. That's a penalty 1% per month multiplied by the employee's tax for that period, for that 6-month period. Okay, and that is levied for the first time in June this year, that they started levying that 1% penalty, and they will keep levying it for every month that the EMP 501 is outstanding, up to 10 months. But hopefully by then people have got the message and they've provided the outstanding return. Now, there is an issue that has come up around this penalty, and that is that SARS says, well, the penalty is based on 1% of the employee's tax, but we don't have an EMP 501 telling us how much that employee's tax is. And so a matter that I haven't put onto the slides, but I just want to bring to your attention, is in the draft amendments that have just been released for public comment, there's a proposed amendment to paragraph 14 of the 4th schedule that will allow SARS to raise an estimated assessment for the employee's tax so that they then have an amount on which they can calculate their 1% penalty. So if the EMP 501 has not been submitted by due date, SARS can then raise an estimated assessment and they can then multiply that by 1%, and that would be the penalty that is charged in terms of paragraph 14. Okay, the other issue with the EMP 501 penalty is that there has been a bit of a glitch on the SARS system, that there's been a clash, that if you end up with let's say, a late payment penalty on the PAYE for the same period that you now have an EMP 501 penalty under paragraph 14, it becomes very difficult to do the request for remission. So they've made the point that they are going to make enhancements to the dispute resolution process so that you can submit more than one request for remission for the same tax period, because you've got one for the late payment penalty, one for the EMP 501 outstanding return. Currently, the system doesn't allow for that. And so what they've said is, in the meantime, you can submit a written request for remission, like a manual process, but they have promised that they will rectify their system soon so that you can actually do the request for remittance in the normal process. So they've given you this interim process. I'm not sure if they have fixed their system yet, but as far as I know, we're still in this interim process where you check on e-filing that the penalty amount that you want to request a remission for is indeed blocked. So first try the e-filing process to do the request for remission. If you get blocked, then you resort to this manual process to do the request for remission on the PAYE penalties. Okay, so if you do have a problem with that, SARS does have some, and you use your PCC at SARS, of course, if you're a tax practitioner, otherwise you've got to contact us at SARS to try and sort out those issues. Okay, so yeah, so that brings me to the end of what I wanted to specifically talk about. I see there is one question here that I'm just going to have a look at from Renee. Company was tax compliant and had a tax refund. SARS paid about 100 Rand extra, which now reflects as the company no longer tax compliant. If it's less than 100 Rand, as I mentioned earlier, that shouldn't count against you. But of course, if it's 101 Rand, then it is a bit of a problem. How do you dispute the tax compliance as SARS calculated the refund and interest? Is it not possible to use the PCC at SARS email address and try and resolve it that way with a consultant at SARS? I would suggest that might be the best way to try and deal with that, to try and, because it needs to be some correction that's done that. But I'm not sure why SARS paid more. Surely you've got a refund that's owing to you and there's interest on that. So if they've paid more, I'm not sure why they would have paid more than what was actually owing. I think you'd have to go in and make use of the PCC at SARS option and try and resolve it with a consultant at SARS. Okay. Any other questions? I'm not sure if there's anything else. Let's have a look. Here's another one from Ian. Let me just, so you're not spending time reading the legalities of the disclaimer. Let me put you back over there. A specific question on the date of recognition of a CGT tax loss, so capital loss. Ian, this is quite detailed, I must say. So a capital gain or loss arises on disposal of an asset. So you would have to look at the time of disposal of an asset. That's when your capital loss is going to arise. So if you've got a company delisted from the stock exchange, and if the company has been liquidated, the time of disposal there is the date on which the liquidator states that there's not going to be any further distribution. So it's the final distribution that is made, or the final settlement, as it were, that is made. So if they've already indicated that there's no distribution to shareholders, then basically the date on which that correspondence was issued would be the deemed date of disposal of those shares. Okay, and that's the date on which your capital loss would arise. So you've said here, period for completion is June 23, but communications already indicate, hopefully there's an official communication from the liquidator indicating that there's no further distribution to shareholders, because on that date, once that communication has been issued, that's the deemed date of disposal in terms of the 8th schedule. I hope that does help you. Okay. All right. So yeah, hopefully that has sorted that matter out. I just want to see if there's anything else. I think we've answered all the rest of it. Okay. So I think that's it. If there are any other questions, gone. Okay. All right. Otherwise, let me just finish off and just say thanks very much to everybody. Thank you for having me. I hope it has been a useful afternoon, and I'll hand you back to Stan. Thanks.
Thank you, Jackie. As usual, food for thought, much food for thought. Thank you to everyone for attending. Your certificates are ready and will be sent out in the next couple of days. If there are any questions you want to ask post this seminar, just send them in to Danny and we'll forward them to Professor Jackie. For the rest of you, since it's not quite the end of the seminar, if you want to remain on, you may. Otherwise, you can have the rest of the afternoon off. And thanks again for attending. Thank you, Danny. Thank you, Professor Jackie. And good night, everyone.
Thanks and goodbye, everybody.